How's it going, everyone? Matt Diamond with Kalshi, and today we're talking another strategy video. In this strategy video, we're going to be highlighting the indicator, the RSI, the Relative Strength Index. And I'm sure a lot of you have heard this, but just to go over what it is for the ones who haven't, the Relative Strength Index, or the RSI, is a momentum indicator used in technical analysis. RSI measures the speed and magnitude of a security's recent price changes to evaluate overvalued and undervalued conditions in the price of that security. And what we're going to do is we're going to put that RSI up, and then we're going to talk about how to trade the event contracts in the S&P 500 daily, the S&P 500 weekly, and the NASDAQ 100 daily, and the NASDAQ 100 weekly. And at the very bottom of the screen, this is the RSI indicator. I changed the color so visually it's a little bit easier to understand. Green is going to mean it's overbought, and red is going to mean it's oversold. And the line in between the red and the green is going to be based on just historical data, the candlesticks, determining whether or not it's going to be in that overbought territory or that oversold territory. Now, being that recently the market has been very strong, it's going to typically be trading towards that overbought territory. When it's vice versa and the market is sold off aggressively, it's going to be trading towards that oversold. But when something is trending to the upside in a very strong market, it's going to be hanging around this green line. So we're going to use that green line as an area of support and resistance. And when it trades below it in a strong market, we're going to expect a potential bounce and continuation of that uptrend. And then when it gets extremely above that green line, a possible pullback. And then we're going to set up some trades regarding that. And this is the S&P 500 daily chart. So let's talk about some continuation trades. Well, when the market pulls back, you notice how the RSI indicator, the line in between the green and the red, it kind of gets right in the middle of it. And these happen to be the areas where things take a dip. So nice dip, and then happens to push up. And then when it pulls back a little bit, and then you can see the line pulls back slightly, those are usually areas of support. And then there's some sort of continuation in an uptrending market. Now, nothing is 100%, but you can see that any dip in the line right here can be a big area of support. And then we're expecting that upside continuation in a strong market. And another example would be nice big move higher and then has a controlled pullback. And you can see the line has a controlled pullback as well in between the overbought and the oversold. And when it comes underneath that overbought a little bit in a strong market, it doesn't remain under that line for a long period of time. The market usually finds some sort of support and then continues to the upside in its uptrend. And the market continues that uptrend, and then it gets to that overbought line, pulls back a little bit, and being that it's a very strong market, it doesn't pull back much, gets under that overbought line, finds some support, and then what happens? Continuation of that trend higher. So now let's go to the S&P 500 daily and trade those contracts, and we'll set the trade up. So as far as those yes or no shares, this is how I see it. If we end up pulling back on that line from the overbought area in a strong market, and we start to find some support as far as the daily goes, we're going to expect some sort of bounce. And if we do, I would want to trade the yes shares of those ranges that are going to be a little bit above where it's currently trading, because if we're expecting a bounce, then we would think there's a high probability of closing in those upper ranges. And then vice versa. If it ends up pulling back a little bit from that overbought line, and we believe that eventually it's going to have a bounce because we're in a strong market, then what I would want to do is look at the no shares of those lower ranges. Because if we're expecting a bounce, then we don't think it's going to trade in those lower ranges. So we would want to trade the no shares on those lower areas. Now, looking at the daily, if we look for potential pullbacks, anytime it crosses the overbought to the upside in an extreme fashion, this is usually where you find some sort of top, and then there can be a pullback to the downside. And then as far as structuring the trade on that, if we're expecting a pullback because it's extended and an overbought territory, then I would think that it's going to trade in these lower ranges. So what I would want to do is trade the yes shares expecting for a pullback, and then vice versa. If we're not expecting the price to continue to the upside because it's in overbought territory and it could pull back, then I would want to trade the no shares to the upside, because if it pulls back, it's not going to get to these upper ranges. Now let's take a look at the S&P 500 weekly chart. And the best way to go about this would probably be to focus on the extremes, because there's a lot of price action in each one of these candles. It represents a week of trading. And as you can see, at the extreme areas of this, of the oversold or the overbought, that tends to be the higher probability setup, because if we look at what's going on in between, there's a lot of choppy sideways action, and we don't want to get caught in that. So let's look at the extreme examples when it's trading very close to that overbought or the oversold line. To start with this one, almost at that oversold, the red line. And then look at what happens. Found some support and had a nice move higher and a big bounce from the low. So it turned out that being able to take advantage of the line being close to the red, which is the oversold line, happened to work well. And then vice versa. So looking for a possible pullback. This is the only other time that it actually crossed into overbought territory. And look at the pullback that happened from the highs. So went over that green line and then big pullback down. So this shows that in the extreme zones on the weekly chart, this is where it can work well. So now let's structure the trades. So let's say it's getting into oversold territory close to that red line and we're anticipating a possible bounce. Here's what I would think that you'd want to do is that if we're looking for a bounce to the upside, then want to trade the yes shares in these upper areas, because if for some reason it does bounce, there is the high probability that it'll close in these upper ranges. And then vice versa. If it's in that oversold territory and we think it's going to bounce, then trading the no shares to the downside has the best probability, because if it does bounce to the upside and it continues that uptrend, it's not going to get to those lower ranges. And now the other side of the trade. So if we're looking for a possible pullback, because the example that I gave up here, it gets into overbought territory and we're looking for a pullback. This is how I'd want to structure it. So if we're trading towards that overbought territory and I think there is going to be a pullback, then what I would want to do is trade the yes shares in these down ranges, because if it does pull back, there's the likelihood that it'll close in those ranges, and then vice versa. So if it's extended to the upside in overbought territory, we don't think it's going to go higher, then I'm going to want to trade the no shares to the upside, because if it does pull back, it's not going to trade in these upper ranges. Now let's look at the NASDAQ 100 daily. And remember, the market has been very strong recently. So there's going to be a lot of times in which it never really gets to that oversold territory. So any dip below that overbought, it usually gets bought up and then trend continues to the upside. So we're going to use that to be able to come up with the strategy. So as you can see, has kind of a push into the overbought, but then dips below. And right when it gets kind of in that area, just below that overbought, a lot of times that's where it finds some support, and then it continues to the upside. And then as this gets up into overbought territory, it does pull back a little bit, but the market is very strong that pullback is short-lived. But that can be used as a strategy that when it gets over that overbought line, we're anticipating a possible pullback. And then once it has the pullback and the line gets just below overbought, what do you know? It finds some support in a strong uptrending market and then continues that uptrend. And you have a nice bounce from the lows for continued upside. And here's a couple more examples. You get the pullback, you get the line that trades just below the overbought, and then what do you know? Some continuation to the upside. You get another pullback, the line trades under that overbought, and then you get continuation to the upside. And then from those pullbacks, when you get that continuation higher, you get this that crosses over into the overbought territory, and there is some sort of pullback to the downside. Nothing is 100%, but just trying to use the RSI to keep it as simple as possible. Now we're going to structure the trade, and we're going to focus on bounces to the upside. So every time that pulls back below that overbought line, we think that there's going to be some continuation. What I would want to do is trade the yes shares to the upside, because if it has that bounce, there's the likelihood that it's going to close in those upper ranges. And then vice versa. If we believe that it's going to bounce to the upside, trading the no shares to the downside, because if it does have that bounce, the likelihood of it trading in those lower ranges is going to be a low probability. And now to look at the NASDAQ 100 weekly chart, each one of these candlesticks represents a week of price action. And in my opinion, I think the extremes of the RSI is what's going to work best with this. So really focusing on those moves that come very close to the oversold. And when they do, looking for weekly bounces. In these instances, they pulled back, got close to the oversold, and had a short-term bounce. And then after that, this line trades really just sideways in between the overbought and the oversold. And that's the stuff that we don't want to get caught in, really waiting till it gets to that overbought. And then when it does, these extreme areas, even though it's not going to be perfect, just knowing that we are in overbought territory and there could be some sort of short-lived pullback. And you can see that this market is so strong that these pullbacks are not very big, but just trying to get an understanding of the basics of this indicator. Now to set up the trades on the NASDAQ 100 weekly. So let's say we're expecting a bounce because it's trading close to that oversold red line. So what we would do is want to trade the yes shares on those upper ranges, because if it does bounce, there is a likely probability that it'll close in these upper ranges, and then vice versa. If we're expecting a bounce and we don't think price is going to go lower, then we're going to want to trade the no shares on these lower ranges. And now the other side of the trade, so it's in overbought territory and we're expecting a short-term pullback, wanting to trade the no shares in the upper ranges, because if it does pull back, it's not going to get to these prices, and then vice versa. Wanting to trade the yes shares to the downside ranges, because if it does actually pull back, there is a likely probability that it's going to close in those lower ranges. So I know there was a lot of different examples, but that's how you can use the RSI when trading the event contracts on the S&P 500 daily and weekly and the NASDAQ 100 daily and weekly. So that's it for the video. I appreciate you watching. Feel free to like, comment, and subscribe, and I'll see you in the next one.